Vertiv Holdings Co., trading under the ticker VRT, is currently sitting at $255.88 as of the market close on Friday, March 20th, 2026. This represents a decline of roughly 5.03% in just one session, a sharp move for a company that has been the darling of the industrial tech sector. If you were looking at your screen during the final hour of trading, you saw a high of 272.84 quickly evaporate as a wave of selling pressure hit the broader market. This creates a fascinating tension because on the surface, everything should be going right for Vertiv. They are literally the plumbers of the AI world, providing the cooling and power systems that keep the most advanced data centers from melting down. The big news right now is that Vertiv is set to join the S&P 500 next week. In the standard playbook of investing, index inclusion is the ultimate green light. It usually triggers massive buying as ETFs and passive funds are forced to add the stock to their portfolios. Yet here we are, watching the price slide right before the big entry. It's a classic case where the market's immediate anxiety over inflation and geopolitical noise is clashing with a massive structural tailwind. Let's look at the reality behind that expectation. Most people see the S&P 500 inclusion as a guaranteed pump, but the reality is that sophisticated traders often use these events as liquidity to exit positions they've been riding for months. Vertiv has gained over 50% year-to-date already in 2026, and in the last 12 months, it's up nearly 200%. When a stock has moved that far that fast, a 5% drop isn't a sign of failure, it's a sign of a market that is catching its breath. While the headlines are focusing on the intraday dip, the deeper story is the partnership Vertiv just expanded with Nvidia. They are now providing the physical infrastructure for the Vera Rubin DSX AI factory designs. This isn't just about selling a few more fans or batteries. It's about being baked into the very blueprint of how future AI data centers are built. If you are using a platform like Robinhood or Interactive Brokers to track these movements, you'll notice that the volume on Friday was nearly 88 million shares, which is massive. That level of activity tells you that the big money is reshuffling the deck ahead of the index transition. The common ground among investors is that Vertiv is a pick and shovel play for AI. Everyone agrees that as long as Nvidia and AMD are selling chips, Vertiv will be selling the cooling systems to manage them. But I want to challenge that simple view. The real value here isn't just in the hardware, it's in the backlog. Vertiv is currently sitting on a $15 billion backlog of orders. To put that in perspective, that is more than a full year's worth of projected revenue just waiting to be fulfilled. This creates a level of visibility that most industrial companies would kill for. When you look at the 2026 guidance they just issued, they are calling for net sales between $13.25 billion and $13.75 billion. The market's expectation was much lower, which is why the stock has been on a tear. The tension arises when you realize that even with this growth, the stock is trading at a high multiple, around 75 times earnings. This is where the skeptics start to sweat. They wonder if we are paying 2030 prices for 2026 reality. But if the backlog continues to grow at over 100% year over year, that multiple starts to look a lot more reasonable. For those of you managing your own portfolios, whether you're using Fidelity Wealth Management or a self-investing approach through SoFi Invest, you have to decide if this dip is a structural crack or a temporary sale. Institutional activity has been incredibly aggressive lately. BlackRock and JP Morgan have been loading up, increasing their stakes significantly over the last few quarters. This institutional support acts as a floor for the stock, but it also means that the smart money is already in. If you are looking for investment help to navigate this, remember that Vertiv isn't just a data center company anymore. They are moving into energy autonomy. They're helping data centers build their own microgrids because the public power grid simply can't keep up with the demand. This is a massive expansion of their addressable market. Instead of just selling the cooling unit, they are now involved in the entire power chain from the moment electricity hits the building. The technicals on the chart are equally telling. We saw a brief dip to $255.13 on Friday, which pushed the stock towards its 20-day moving average. For traders using the Robinhood app or the Fidelity mobile app to watch the candles, this is a key level to hold. If Vertiv holds this area, the narrative of a healthy pullback remains intact. However, if it breaks lower, we might see a more prolonged consolidation. This is especially important for those holding fractional shares or playing the options market on the Robinhood trading platform. The volatility we're seeing isn't unique to Vertiv. It's hitting the entire sector, from Nvent Electric to Eaton. It seems like the market is testing the resolve of the AI infrastructure bulls. Comment below how many shares of Vertiv you currently hold, or if you're waiting for a deeper dip before stepping in. Let's talk about the business model for a second, because it's important to understand why this company has suddenly become a titan. For years, Vertiv was a steady, somewhat boring industrial player. They grew out of the old Emerson network power business, but the shift from traditional cloud computing to high-density AI workloads changed the game. A traditional server rack might use 10 to 15 kilowatts of power. An AI rack can use 100 kilowatts or more. You cannot cool that with just air. You need liquid cooling, and you need highly specialized power distribution. Vertiv has spent the last 2 years positioning themselves as the leader in liquid-to-chip cooling. They aren't just selling products, they're selling a solution to a thermal crisis. This is why their margins are expanding. When you are the only one who can solve a mission-critical problem for a trillion-dollar company like Nvidia, you have immense pricing power. This is reflected in their adjusted operating margins, which are pushing towards the 23% range. If we look at the future outlook, there are 2 main catalysts to watch. First is the conversion of that $15 billion backlog. If Vertiv can show that they are overcoming supply chain hurdles and actually delivering these systems faster than expected, the earnings beats will continue. Second is the EMEA and Asia-Pacific recovery. Right now, a huge chunk of their growth is coming from the Americas. If we see a synchronized global build-out of AI factories, Vertiv has a lot more room to run. On the risk side, the biggest threat is a slowdown in capital expenditure from the hyperscalers like Microsoft, Google, and Amazon. If they decide they've built enough capacity for now, the first thing they'll cut is the infrastructure orders. However, looking at the current landscape, that doesn't seem likely in 2026. The race for AI supremacy is still in the build phase, and that is the sweet spot for Vertiv. Whether you're using an individual brokerage account at Fidelity or a robo-advisor like the Schwab Intelligent Portfolios, the inclusion of a name like Vertiv represents a shift in what industrial means in a modern portfolio. It's no longer about tractors and engines, it's about the thermal management of the digital world. The expectation was that Vertiv would struggle to maintain its 2024 and 2025 momentum. The reality is that their growth is actually accelerating as the scale of AI projects moves from megawatts to gigawatts. This disconnect between the fear of a bubble and the reality of the order books is exactly where the opportunity lies. As we look toward the next few months, keep an eye on the interest rate environment. Since Vertiv is an industrial company with a decent amount of debt, though they've brought their leverage down to a very healthy 0.5 times, they are sensitive to the cost of capital. If inflation stays sticky and rates stay high, it might temper the pace of new data center starts. But for now, the momentum is clearly on the side of the infrastructure providers. Online investing has made it easier than ever to track these macro shifts, but the fundamental analysis remains the same. Follow the cash flow. Vertiv's free cash flow generation is becoming a massive story. They generated nearly $1 billion in cash from operations in the fourth quarter alone. That gives them the firepower to acquire smaller competitors or return capital to shareholders. To summarize the situation, we have a stock that just took a 5% hit on heavy volume right as it prepares to enter the world's most famous index. The expectation was a smooth ride into the S&P 500, but the reality is a market-wide sell-off that has created a moment of doubt. Vertiv's fundamentals, however, remain tethered to the most powerful secular trend in the economy. Their partnership with Nvidia is deepening, their backlog is at record highs, and their 2026 guidance significantly outperformed what Wall Street thought was possible. The current price of $255.88 might look like a peak to some, but when you look at the visibility of their revenue through 2027, it looks more like a company that is finally being valued for its true importance in the tech stack. If you are using an online investment platform or a specialized trading platform like Interactive Brokers to manage your trades, you know that the best entries often come during these moments of maximum tension. The market is daring you to sell your winners to protect your gains. But the story of Vertiv isn't finished. We are moving from the era of air cooling to the era of liquid cooling, and Vertiv owns the patents and the relationships to dominate that transition. The authority of their market position is unquestioned by the institutions, and despite the short-term price action, the structural growth case is stronger than ever. The central insight here is that the market is currently pricing in macro fears while ignoring the micro-level strength of the industrial AI supply chain. The gap between what the average investor sees, a falling price tag, and what the analyst sees, a growing high-margin backlog, is exactly where the alpha is found. Stay grounded in the numbers,